Hey, what's up everybody? Welcome back. And have you ever noticed that when you're looking at a stock chart, things seem to get a little crazy right at the top of every hour? Like suddenly there's a surge in volume and the price jumps up or down. It's not your imagination. This actually happens all the time in the stock market. And there are some really interesting reasons why. In this video, we're going to break down the 6 key drivers behind those hourly spikes in volume and what they mean for you as an investor. So, if you're ready to level up your trading knowledge, grab your notebook because class is officially in session. First up, let's talk about the big players in the market: institutional investors and hedge funds. These guys are managing billions, sometimes trillions of dollars, and they can't just throw huge buy or sell orders onto the market all at once. That would create chaos. Instead, they use something called algorithmic trading. Basically, computer programs, algorithms, break up these massive orders into smaller chunks and execute them strategically throughout the day. And guess what? A lot of these algorithms are programmed to make those trades at regular intervals, like, you guessed it, the top of every hour. 2 popular strategies they use are called TWAP, time-weighted average price, and VWAP, volume-weighted average price. These strategies aim to get the best possible price for their clients by spreading out trades and minimizing their impact on the market. They don't want to move the price too much with a single, massive order. They want their trades to blend in, look natural, and not cause any sudden price swings. So, next time you see a spike in volume right at the top of the hour, there's a good chance it's an algorithm working behind the scenes, carefully executing a big institutional order. Now you might be thinking, okay, algorithms make sense, but what about human traders? Do they follow this hourly pattern too? And the answer is a resounding yes. Even us humans, with all our complex emotions and decision-making processes, tend to gravitate towards those nice round numbers on the clock. Think about it, when do you usually check your stocks? Probably at the top of the hour, right? Maybe during a quick break at work or while you're sipping your coffee. It's just natural for us to organize our day around these hourly milestones. And it's not just about checking our portfolios. Traders often use these hourly intervals to reassess their positions, adjust their strategies, or place new trades based on the latest market movements. It's like a mental reset button, a chance to step back, analyze the situation, and make decisions with a fresh perspective. Plus, let's not forget about those pesky things called meetings and lunch breaks. Traders are people too, and they often schedule their day around these events, which can lead to bursts of activity at the beginning or end of the hour. Here's another big one: economic data releases. The government and other financial institutions love to drop important economic reports at the top of the hour, especially at 10 a.m. Eastern Time. Think about things like the ISM Manufacturing Index, consumer sentiment reports, or even the big kahuna itself, the monthly jobs report. These data releases can have a huge impact on the market because they give investors fresh insights into the health of the economy. And when I say impact, I mean big, volatile price swings. For example, a surprisingly strong jobs report might send stocks soaring as investors become more optimistic about future growth. On the flip side, a disappointing manufacturing index could spark a wave of selling as fears of a recession start to creep in. The key takeaway here is that these data releases often create a sense of urgency in the market. Traders are eagerly waiting to see the numbers, and as soon as they hit the wire, they're ready to pounce with buy or sell orders. This flurry of activity often leads to those characteristic spikes in volume right at the top of the hour. It's all about reacting quickly to the latest information and trying to capitalize on those short-term price movements. Now let's talk about the retail investors, the individual investors like you and me. While we might not be moving billions of dollars like the big institutions, our collective actions can still influence the market, especially when it comes to those hourly volume spikes. See, many retail brokers, especially those that offer fractional share trading, batch up their customer orders throughout the hour and then send them to the exchanges all at once. Why do they do this? Well, it's often more efficient and cost-effective for them to execute trades in bulk rather than individually throughout the day. And you guessed it, a popular time for these batch orders to hit the market is right at the top of the hour. One platform that's known for this is M1 Finance. They're a popular choice for long-term investors who are steadily building their portfolios over time. And since M1 Finance executes its trades at the beginning of each hour, it often creates these microbursts of buying activity, especially in popular stocks and ETFs. Now these microbursts might be small on an individual basis, but when you combine millions of retail investors all making trades at the same time, it can definitely contribute to those hourly volume spikes that we see on the charts. Ever heard of index funds and ETFs? Of course you have. They're super popular, and for good reason. They're a simple and effective way to track the performance of a particular market index like the S&P 500 or the Nasdaq 100. But here's the thing. These funds need to rebalance their holdings periodically to make sure they're still accurately reflecting the underlying index. For example, if a company gets added to or removed from the S&P 500, all the index funds and ETFs that track that index need to adjust their holdings accordingly. And guess what? This rebalancing process often happens at specific times throughout the day, sometimes synchronized with those hourly time blocks. Now imagine this happening across hundreds of different ETFs, each with billions of dollars under management. Suddenly you have a massive amount of buying and selling activity compressed into a relatively short period, which can lead to, you guessed it, those hourly spikes in volume. It's like a giant game of musical chairs as these ETFs shuffle their holdings around to stay in sync with their respective indexes. The final piece of the puzzle is liquidity. Liquidity basically refers to how easily you can buy or sell an asset without causing a significant price change. In other words, a liquid market has plenty of buyers and sellers ready to trade at any given time. Now here's why this matters. Liquidity often fluctuates throughout the day, and it tends to be higher at predictable intervals, especially at the beginning of each hour. Why? Well, it goes back to all the factors we've already discussed: algorithmic trading, human behavior patterns, economic data releases, and so on. All of these things contribute to increased trading activity at the top of the hour, which naturally attracts more buyers and sellers to the market. Traders know this, and they often prefer to execute their larger trades when liquidity is higher. It reduces their risk of slippage, which is basically the difference between the price you want to trade at and the price you actually get filled at. When there are more buyers and sellers in the market, it's easier to get your orders filled quickly and efficiently without moving the price too much. So if you're a trader who needs to move a large number of shares, it makes sense to wait for those hourly liquidity peaks when you're more likely to find a counterparty for your trade. So there you have it, the 6 main reasons why stock volumes often spike at the top of every hour. It's a fascinating interplay of algorithms, human behavior, economic data, retail trading activity, ETF rebalancing, and good old-fashioned liquidity. Understanding these factors can give you a serious edge in the market. You'll be able to anticipate those hourly surges in volatility and make more informed trading decisions. Remember, knowledge is power, and in the fast-paced world of trading, every little advantage counts. So, next time you see those hourly spikes, you'll know exactly why they're happening. Happy trading!